Should you buy shares of Chipotle before or after its upcoming 50-for-1 stock split? At nearly a $90 billion market cap, has too much already been priced into this company, and are the expectations simply sitting too high over at Chipotle? And lastly, with a nearly 7-year uptrend hanging in the balance, can this company continue to power through new all-time highs, or will you see shares of Chipotle get rejected, come back down to levels where it might be more attractive to step in? We'll answer all of those questions and a whole lot more in today's video. Hey guys, hope you're doing well out there. It's time to catch up with shares of Chipotle Mexican Grill, ticker symbol CMG. Looks like it is destined to head to $3,500 a share. As you see in the after hours, it's sitting spot on at $3,400. So year to date, this company is up over 47%, and over the past 1 year, up more than 60%. So based on the looks of its stock price, you probably think this company sells AI, but in fact, they sell burritos and burrito bowls and do it to a damn good T. In fact, this company has some of the best fundamentals and financials, especially for the quick service industry, and we'll take a look at that in just a little minute. But over at the Stock Study channel, it's not all about the story. In fact, it's very little about the story and a lot more about the fundamentals and the financials, and along with that, the valuation. And there's simply a lot priced into shares of Chipotle. We'll get more into the valuation as we walk along, but simply the returns on this company might be limited simply because of the price you're paying at the current moment. Now, before we get into all of that, at the top of the video, I did want to cover its upcoming historic 50-to-1 stock split that will happen on a post-split basis at market open on Wednesday, June 26th. So whatever the price of shares of Chipotle is at the end of the trading day on June 25th, what you'll have is the price of those shares divided by 50 the following day, and the number of shares outstanding multiplied by 50. So fundamentally, as we'll speak, that changes absolutely nothing over at Chipotle. A stock split simply doesn't do anything but decrease the share price and increase the shares outstanding. So you'll still have the nearly $90 billion market cap, you'll still have the same valuation, you'll still have the same yield if this company had one, and everything will remain the same except the price per share and the number of shares outstanding. So that's something to keep in mind. A stock split really doesn't change anything over at really any company that it's ever happened to before. Now, what I do want to say is this 50-to-1 stock split certainly is historic when it comes to the New York Stock Exchange. In fact, the last time there was a 50-to-1 stock split was of Berkshire Hathaway's back in 2010, so roughly 14 years ago. So certainly 50-to-1 stock splits don't happen very often, and regardless, if this doesn't affect your buying or selling decision, that's absolutely fine. But keep in mind, this 50-to-1 stock split certainly will get a lot of news and will get a lot of eyeballs simply because of how historic of a decision it is. Now, to answer the question whether you should pick up shares before or after this upcoming stock split, the answer you probably weren't looking for is that it simply doesn't matter. That's right, like we said, fundamentally nothing will change with shares of Chipotle before or after the stock split, so it really doesn't matter whether you go out and buy shares today, tomorrow, or after the split happens. The only thing that should factor into your decisions is what you feel about the company's fundamentals, their business model, and their financials. And certainly that might have a material impact change between now and then, but certainly your buying or selling decision shouldn't be based on the fact that a stock split will be happening. Now, with that being said, there are a few things that a stock split does affect. Like we said, the price of each share will be divided by 50. And so if you are a retail investor that maybe is only investing with a couple thousand of dollars, or maybe you have a brokerage that doesn't allow for fractional shares to be held, well then at that point, having shares of Chipotle being closer to $60 or $70 a share makes a whole lot sense for you, because you're now able to start a position in Chipotle without having to commit nearly $3,400 for one share. Certainly that makes shares of Chipotle far more available to retail investors, and alongside that makes them far more available to employees as well. Certainly if you don't want to start a $3,400 position in Chipotle at the current time, that's kind of hard to do, certainly if you're not allowed to have fractional shares in your brokerage. So that is one thing that a split does do, is it makes shares more accessible, more available to a broader range of investors, particularly the ones that trade with smaller sums of money. The other thing a stock split will do is affect the availability of options trading, as now instead of buying one contract which has 100 underlying shares worth $350,000, you'll be able to pick up one contract that might be worth $6,000 or $7,000 depending on where shares are trading after the split. So again, far more accessible to your average retail investor, whether you're not buying $350,000 worth of an options contract. And then lastly, with the share price coming down, Chipotle can at least be considered to be included in price-weighted indexes such as the Dow, where the price of your stock really determines the weighting that you get in that index. And so, for example, McDonald's is one of the quick service restaurants currently sitting in the Dow, and Chipotle at $3,400 a share certainly couldn't be entered into the Dow simply because of how large of an impact it would have. But at closer to $60 or $70 a share, yeah, at that point, that makes a whole lot more sense. So a couple things that do happen with a stock split is that shares become more accessible, options trading becomes again more accessible, and the inclusion into price weighted indexes become more of a reality. But underlying fundamentals and financials, really nothing changes across that board. And so when analyzing a company from an investing decision, a stock split really shouldn't have any impact either way. Now, before jumping into Chipotle's financials and fundamentals, I did want to mention that this is a company that actually does not franchise. And so all of the Chipotles that you see are actually owned wholly by the corporation itself, and they're also operated directly by Chipotle Incorporated. And so that's certainly important to keep in mind. This is a company that does not franchise, and so they have more control and more direct impact on how the business really operates on a store-to-store level. And certainly that's impressive. You have a company like McDonald's that has chosen to go down the franchisee route, and maybe you can see that McDonald's has a little bit less control over the marketing, over the branding, over really the day-to-day operations for all of its restaurants. But with Chipotle, what you get is a company that owns all of their restaurants and so can control exactly how the marketing, how the pricing, and how the branding of those stores really progress into the future. So keep in mind, Chipotle is not franchised and all restaurants directly owned by the corporation. Now, you did get Q1 earnings with Chipotle just over a month ago, and this is really where the story looks absolutely fantastic. And this is where Chipotle begins to deserve its high valuation and deserves to trade at a premium to the market. This is a company that posted $2.7 billion in quarterly revenue. That was growth of 14% year over year and beat estimates close to $30 million. In terms of their non-GAAP EPS, that also came in with a beat up to $13.37. Now, the comp store sales, which is a super important metric in the restaurant, in the food business, which looks at the year-over-year growth in revenues for stores that have been operating for at least 13 consecutive months. And comp store sales up 7% over at Chipotle. That is a strong number. On top of that, you had expanding operating margins up to 16.3%. Last year, they were at 15.5%. You also had restaurant level operating margins expanding by roughly 190 basis points up to 27.5%. And restaurant level operating margins is actually, I think, a number more important for a company like Chipotle. That is basically your revenues minus all of the operating costs to just run the restaurant itself. So even though you have G&A and depreciation and amortization as operating costs, those aren't actually costs that go into simply opening and running your restaurant. And so the restaurant level operating margins is one I like to watch, especially for a company like Chipotle. And the fact that that is increasing shows me that this company certainly has levers to pull when it comes to the pricing of their food and increasing their operating efficiencies. On top of that, this company continues to open new Chipotles. They opened 47 new restaurants, including 43 that have a Chipotlane, which is their drive-through sort of mobile order service that this company now provides. This company really did lack in that drive-through area, but considering the fact that 43 of their new 47 locations have a Chipotlane, I think this is a company now betting big on drive-through and mobile orders, probably in order to speed up the times that they can deliver their food in and allowing more unit volume to progress through each store on a daily basis. Now, as we'll get into their quarterly Q1 numbers, we also have to take a look at 2024 outlook that this company provided. So they're expecting comp store sales for the full year to be in the mid to high single digit range. That is basically in line to where this company was in their Q1 at close to 7%. They're also expecting 285 up to 315 new restaurants, with again over 80% having that drive-through service already installed in that restaurant. Again, betting big on drive-through and mobile order. And so if we take a look at the earnings and revenue expectations for this company heading into the next couple of years, they're expected to grow earnings in that low to mid double digits, called over the next 3 to 5 years. As for this year, they're expected 15% growth, then 13.5%, and then close to 14% growth. Again, that is pretty phenomenal growth for a restaurant chain operating at this size. They have nearly 3,500 Chipotles already open, and they continue to expect to open close to 300 for the full year. And so this is a company expected to continue to ramp on that top line. And look, you're expected to nearly double your revenues over the next 5 years. So certainly the growth on that top line is there over at Chipotle. Now, what's even better is the bottom line growth, as that far exceeds your revenue growth, as you expect bottom line to grow somewhere in that 20 up to 24% over the next 3 to 4 years. And while that might seem like a difficult task, certainly I think Chipotle has the levers to pull both on their pricing and operating efficiencies to make that happen. This is a company that can continue to rapidly expand earnings per share over the next couple of years. And so you're expecting EPS to more than double over the next 4 years. And really that is the price you pay for a company that is, again, expected to double their earnings over the next 4 years. You're paying a hefty premium at north of 60 times a forward priced earnings, especially if you consider these moves that you got today and in the after hours. You're certainly paying north of 60 times an earnings multiple for EPS growth expected to be closer to 24%. You're paying nearly a 3 times a PEG ratio for, again, a burrito chain, but a extremely well-run burrito chain nonetheless. So the question really comes down to how much are you willing to pay for a company like Chipotle, and really how much of the growth has already been priced in. We look ahead to a couple years, this is still trading north of 40 times an earnings multiple. And so really have the next, call it 8 to 12 quarters over at Chipotle already been priced in. And if you were to buy it at the current levels, are you sort of chasing the story that's already 3 to 4 years out? Again, that's the question you have to ask yourself. What price are you willing to pay for shares? Now, as we see this one over the past year on a GAAP basis, the price to earnings certainly has shot up from close to 43 times now up to close to 70 times. Again, this is on a trailing 12 month, so not looking forward, but on a trailing 12 month basis, nearly 70 times. Again, once again, really, really expensive for Chipotle. And the fact that you see the price to earnings have steadily rised despite growing your earnings at close to a 24-25% clip just means this company's price appreciation is far outpacing their earnings growth. And well, that's not a recipe that can continue on into perpetuity. At one point, you do price in too much growth, and well, at that point, you're stealing some of your returns from the future with all that growth already priced in. Now, I do want to talk about Chipotle's price hikes, as this is a company that actually does have pricing power and has been able to take pricing at least a little bit over the past few years. And while they have gotten at least some backlash over social media for it, this company is still proving people are addicted to their burritos and bowls. And the fact that they're willing to pay a higher price despite complaining a little bit on social media certainly doesn't have any meaningful impact to their business, at least as of yet. So over the past 2 years, this company has raised prices nearly 4 times, and those being for various reasons. And so early in 2021, they took roughly 4% of pricing. That was due to the cost of rising wages. And then later on in 2022, they also took a nearly 4% price hike at that point. And then at the end of 2022, they upped their prices by roughly $1 for their entrees. And so this is a company taking prices just little by little to a point where it might not come off as meaningful to your average customer, at least one that doesn't enter Chipotle often. But for their regular customers, yeah, these price hikes certainly can be noticeable. And again, those are what the people that went on social media were talking about, the fact that this company continues to hike prices, especially during an inflationary period where your middle income customer certainly is feeling the pinch on their wallet. And certainly Chipotle has to do that for the fact that rising wages, and on top of that, you also have rising food, beverage, and packaging costs. At some point, they have to take pricing, and the fact that they have been able to without really seeing a significant drop off into their customer base, I think that just shows this company certainly does have pricing power, at least for now. At some point, if they take far too much pricing too fast, I think that will be a large turnoff for their primary customer base. Now, in terms of their Q1 statement of income, that looks absolutely phenomenal, as you have $2.7 billion in total revenue. Like we said, that was 13% growth year over year. Now, what you have is these operating costs, these restaurant operating costs that we like to see come down as a percentage of revenue. And so last year, you had food, beverage, and packaging at roughly 29% of your total 100% of revenues. Now, in Q1 of this year, that is sitting at roughly 28.8%. So you have a roughly 40 basis point decline in your food, beverage, and packaging cost, again, as a percentage of your overall revenue. So as you continue to grow revenues, your food, beverage, and packaging costs not nearly increasing as fast, allowing you to expand margins on that line. Similarly, you saw a same thing on the labor side, expanding those operating margins on a year-over-year basis. And so, like we said, these price hikes are really what has allowed Chipotle to continue to grow their revenues at a faster clip than the operating costs to run those restaurants really have grown. And if they were not to take those price hikes, yeah, these numbers certainly wouldn't be looking as good. And in fact, they'd probably lose more money considering how fast wages and the cost of goods really have gone up over the past year. In terms of other operating expenses, those also, again, coming down as a percent of revenue. That is what we like to see. And so we take our $2.7 billion in total revenue, we subtract off $2.26 billion in operating expenses, and we're left with $440 million in income from operations. Last year, we were closer to $360 million. Once again, growing our operating margins from 15.5% up to 16.3%. And that, again, similarly allows us to grow our net income margins from 13.3%, from 12.3 up to 13.3%. And as we saw in the expectations, you can expect those revenues to increase at close to 15% year over year for the next couple of years, and the bottom line earnings to increase faster at closer to 20%. And so this company will not only just continue to grow revenues, but get far more efficient in terms of their operating costs. They'll continue to bring those down as a percent of revenue, and that's certainly what we like to see, especially for a food and quick service business like this. Now, with the shares outstanding, that is also going down. This is a company that has an active buyback, and they're exercising that. And so you see your shares coming down to 27.6 million outstanding shares. What you'll see after the stock split, though, is this number multiplied by roughly 50, and so you'll see a lot more shares outstanding. But keep in mind, the price per share will be divided by 50 to kind of offset that just as much. Along with a great income statement, this company has a terrific balance sheet, as you're sitting on roughly $730 million in cash and cash equivalents, another $90 million in receivables. Now, what I do want to point out is on sites like Seeking Alpha, you might see the debt for this company relatively high, as there you see they have roughly $1.4 billion in cash, but then $4.16 billion in total debt. And so if you were to just look at it on a face value, you might think that Chipotle is sitting on a ton of debt that might not be good. But I want to point out that a lot of that $4 billion comes in the form of operating lease liabilities. And so that's not really long-term debt. In fact, this company has no long-term debt. As you see, that's not even a line item on their balance sheet. And so majority of their debt that they count is those operating lease liabilities for the restaurants really that they operate. And so that I wouldn't consider a debt. In fact, that actually might be considered an asset for Chipotle, and it does show up on the asset line in terms of operating lease assets. And so really that operating lease liabilities line item, not really a debt, but does show up in terms of long-term debt on a site like Seeking Alpha, maybe even Yahoo Finance. So keep that in mind. This company actually has a terrific balance sheet, and one that might not look so terrific on face value, but a lot of those debt is just these operating lease liabilities. Along with that, in terms of their cash flows, we get to $360 million in net income for the last 3 months. We get to add back some depreciation, amortization, a little bit of stock-based compensation. The managers over at Chipotle certainly do get paid well, and we get to operating cash flows close to $570 billion. Last year, we were only at 455, so significant jump year over year on those operating cash flows. Now, this company does do a little bit of capex, close to $130 million in terms of building out those new Chipotles and Chipotlanes. And so you're looking at close to $430 million in terms of free cash flow. That's for the quarter ended March 31st over at Chipotle. So certainly that is impressive. For just 3 months, they're doing over $100 million in free cash flow per month. Now, what they do with that free cash flow, they pick up some investments, they sell off some investments, and then they really try to use a lot of that cash flow towards the buyback of their common stock. Now, in this most recent quarter, they had to slow that down simply because of the timing of that 50-1 buyback announcement. They couldn't pick up shares near when they announced that buyback. And so once again, they'll resume this buyback and probably use a large amount of that free cash flow to continue on with that buyback. This company, again, doesn't have any debt, so they don't need to pay that down. And they really have no use to bring on more debt, as they are free cash flow positive and continue to have enough operating cash flows to open up 4 new Chipotle restaurants and do really any restaurant level activities. So from a financial perspective, this company looks terrific. Their financial statements look great. The balance sheet looks phenomenal. This company continues to grow fast on that top line and grow even faster on the bottom line. Now, what looks even better is the stock chart of Chipotle, as you have this one on a nearly 7-year uptrend, continuing to make higher highs and higher lows, breaking through to new all-time highs seems like every single day. Now, you are sitting smack dab in the middle of this range. Now, the reason I dissected this channel in blue lines with this red line is simply because this blue line channel is a pretty big range. You have a basically 100% swing from the bottom end to the top, and so this red line sort of splits it in the middle and maybe highlights some levels where possibly you can look to take some profits and can maybe signal where shares of Chipotle will continue to stall out well, if they ever do. Now, on a more shorter term trend line, this company over the last 3 months certainly has been making an impressive set of higher highs and higher lows. And once again, that continues to blast through to new all-time highs over the past couple of days. Now, would I be eager to pick up shares of Chipotle at this level? Probably not. I think both from a fundamental and technical perspective, this one does certainly look overbought, look a bit overvalued. And I'd wait for a pullback in this one. The first level where I think you could pull the trigger on shares of Chipotle, certainly if you're extremely excited to pick this one up and really have no position and want to open a position early on, I think your first level is closer to the bottom end of this range at roughly $3,150 a share. This was a pretty decent period of consolidation for shares of Chipotle, and I think at this level you can look to find some support. Now, what you have upcoming over really the next couple of days is that 50-to-1 stock split. And so really what I would do with shares of Chipotle is wait for that stock split to happen, really see what volume looks like, see how the shares trade out. And if you get a big dump out in shares of Chipotle, this one can come back down, call it to the $2,800 level. And this is a range where I would be far more excited to begin a position in shares of Chipotle. At this level, closer to $2,800 a share. On a post-split basis, that would be sub $60. That is where I would be looking to at least enter into shares of Chipotle and begin a position. If shares continue to head down, as you get closer and closer to this uptrending trend line, I think you get more and more aggressive in your buys. And if you ever come back down to $2,200 a share, which post-split would be sub $50, I think that is where you begin to unload your full position into Chipotle and allocate your full holding. From a technical perspective, that level will certainly be a pretty good support line, considering you have a nearly 7-year trend in your favor. And on top of that, the valuation will come down by close to 30% with that drop. And so these heavy price to earnings multiples will be cut basically in 2/3, coming down to your low 40s. And I think that is a far, far more attractive valuation for Chipotle. It would still be expensive, but keep in mind, this is a company with many years of growth ahead of itself. And one, I think that will relatively stay expensive for a long time to come. Maybe not nearly at 60 times of an earnings multiple, but certainly closer to a 30 and 40 times earnings multiple can be reasonable for this company. So that was my take on shares of Chipotle. One, I would wait to see what happens after the stock split. Certainly if you get a dump out to the bottom, I think you have some levels where you can pick up shares in Chipotle. I would wait for pullbacks because this one is looking far too stretched, both on a fundamental and technical perspective. Certainly if you can continue the rally, I think while that could be a tremendous moneymaker over the next couple of quarters, I think at that point you're probably chasing capital, not something I like to do at this point. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.